Good morning, everyone, and welcome to Financial Management. So, this is module number 6 in our Money Smart program, and this is about how you can make better decisions by knowing how your money is moving in and out of your business. So, hopefully, you have your participant manual that you were able to get that. And you are going to, a lot of the things that we're going to talk about today, you will have in your manual. My name is Brenda Bryant. I am an instructor for UNR Extension. And this is a 13 module program called Money Smart. And it is Money Smart specifically for people like you who have small businesses. So in today's module, we're going to be talking about money management, how to manage the money that's coming in and how to manage the money that's going out. We're going to talk about things that you have already talked about before because you are a business owner. You've looked at budgeting and bookkeeping and financial statements and all that other stuff. Let's get deeper into what do they mean, how do they affect your business, and how do they help you run a better business or run your business better. So we're going to look at, for our learning objectives, explain the concept of financial management and its importance to a small business and its owner, to identify financial management practices, rules, and tools commonly available to small businesses, and explain how financial management practices, rules, and tools actually work. We're going to look at startup financing, financing a growing business, financing working capital, and financing fixed assets. Now, some of that might sound a little strange to you right now, but by the time we finish, you should be okay. So, in your manual, I want you to think about what is it that you know about financial management and what is it that you would like to know. Put it in the chat for me, please, if you have some specific thing that you would be interested in learning. Okay, so let's start out with the benefits of financial management. How to reach your goals by making good decisions. So, the bottom line for you as a business owner is you cannot run your business by the money alone, but you cannot run your business without understanding how your money works. So, we're going to be talking a lot about how money moves in a company, how you get money coming in, how you send money going out, and how you look at that to see, is this the right method that I'm using? Is this helping me understand how to be profitable, how to project my growth, how to plan for how I want my business to run? So budgeting is a big issue. Everybody talks about you need a budget. I have a tendency to think a little bit differently about budgeting. I would rather that you had a spending plan. And a spending plan is really simple. It's a piece of paper. On one side, it says money coming in. On the other side, it says money going out. And it's basically you are tracking what's happening in your business. I'm not asking you to change anything that's happening. I'm asking you to be aware of what's happening. Once you are aware of how your money comes in and how your money goes out, then we can start looking at setting up a budget because the budget will be based on how things work in your business versus how they work from a theoretical idea. Okay. So we're going to be looking at different ways that money comes in and different ways that money goes out. So you have a sample budget in your participant guide, and that sample budget is on page 8. So it looks at different kinds of things that it thinks you may be needing to keep track of: rent, utilities, phone, insurance, employees, etc. So it's got a whole list of things. What I want you to do is not only look at the list that they have in their categories, but I want you to think about what's happening in your business. Are there some things here that you look at and you go, well, I don't really need that in my business? Or you look at it and say, hey, they didn't think of whatever that thing is that you're doing that you need. Okay. So you're going to set up your list of things to manage based on the business that you have, the money that you have coming in, and the money that you have going out. You may not have employees, so that would not be something that you would need to look at. You may not have contractors where you are asking someone outside of your company to work on a project for you. If that's the case, you don't need that. But what if you do have those? Then you want to make sure that that's included in your money management process so that you know how much is going to be going out and you know how much is coming in to cover that. When you are looking at um, some things about how you track things. Let's look at basics. Bookkeeping is very simple. Bookkeeping is nothing more than tracking what is coming in and going out of your business financially. So I always think of a bookkeeper as a historian. The bookkeeper tracks what you've already done. They can't track what you are planning to do, and they can't track what you're going to do in the future because it doesn't exist yet. For a bookkeeper, bookkeeper is very practical. If I'm your bookkeeper and you walk into my office and you tell me that you're going to go and get some gas, all you did was just interrupt my day. That's all you did. Because that doesn't tell me anything tangible that I can do from a bookkeeping standpoint. What does tell me something tangible is after you go get gas and you bring me a receipt. And you bring me a receipt and it says you spent $50.50 on gas. Now I can actually do something about that. Because with that $50.50 in gas, I now have a transaction that I can actually write down, shows how much actually left your account and went to pay for the gas. Hold on one second. I want to get the link for the financial for the manual for you. And whoops, I will have to put that in a different spot for you. So hold on a second, please. To- Okay, put this in here for you. So that's where you can pick up I put it in the chat. So you can pick up your um, participant manual. I don't know, let me get back to where we were. Okay, so So we talked a little bit about the benefits of financial management, and now we're going to be looking at what a bookkeeper does. Okay. So as I said before, a bookkeeper is more of a historian than anything else. It's not real for the bookkeeper until it actually happens. So you telling me that you're going to get gas does nothing. But when you bring me a receipt for gas, now I can go into action as your bookkeeper. And because now I have something that I can put into our, and in accounting terms, we call it in your books, which means that what we're doing, the transactions that we keep track of, that we do that what we call the books. Okay. So if you hear that term, we're talking about the transactions that you have happening in your business that you're, and it doesn't have to be a bookkeeper. It could be whoever your person is, your financial professional who is keeping track of all your transactions. So, why do we even need to do this? Well, think of what you do at home when you get your paycheck from your W-2 job. When you were a W-2 employee, what did you do with it? You sat down and said, okay, I got X amount of dollars in from my paycheck, and then I have Y amount of dollars that have to go out for my bills. So I need to see how much is coming in, that's my paycheck, and how much is going out, that's my bills. And we do the same thing in business. How much is coming in? That's coming in from revenue from things that we sell, whether it's a product or service. It's coming in from maybe we have loaned somebody else some money and they're paying us back. That's money that's coming in. Okay. And then what is the money going out? Do I have vendors that I have to pay? Do I have rent that I have to pay? Do I have utilities that I have to pay, etc.? So from that standpoint, it's not that different from what you already do. The terminology may be a little different. So what we're going to do is for some people, they want to say, I want some software to do this. I don't know how to do this on my own. I need some kind of software to use. Well, if you're doing your books and you need software, you're going to have to figure out what kind of software to get. Now, most of what you've probably heard about is QuickBooks. QuickBooks is a very good software, but you still need to learn how to use it effectively. If you are just starting out in your business and you know how Excel works, use an Excel spreadsheet. When you say, well, I don't understand Excel, I don't know what Excel is, then grab a plain piece of paper, like I said before, put what's coming in on one side, put what's going out on the other. The point is, every time money touches you, whether it touches you because it's coming into you or it touches you because you are sending it out to pay something, you need to record it. You need to have some kind of a spending journal that will help you keep track of what's going on in your business. So we want to, and these again, I don't think I'm teaching you anything that you don't already know. You just may not have used this particular terminology for what you're doing, but it's probably the same stuff that you've been doing for quite a while as an adult who has a job and who pays bills. So what do? You say, okay, well, let me sit down and figure out what needs to be paid out of this paycheck. which is the same thing as a business. You're going to say, let me figure out what has come in for this time period. If you do it on a weekly basis or if you do it on a monthly basis, but it needs to be consistent because the bills have to be paid and you have to be paid. You have to have money coming in to cover all those things that are in your business. Now, we're going to talk about some things that you may or may not do that I'm going to recommend that you do. Okay. So, one of the things that I'm going to recommend that you do is that you reconcile your bank account. So reconcile may or may not be a word that you have heard before or that you understand what it means. Reconcile means simply the bank sends me a statement. I am going to match what the bank says against what I said I did. So if I'm looking at my spending journal and I'm matching that the bank said I went to ABC Company and I spent $17.25. My spending journal says I went to ABC Company and I spent $17.25. We agree. So the point of the reconciliation is that the bank and I agree. Now, what kind of statements do you get? If you have credit cards, you get credit card statements. Understand, credit cards come from banks. I don't care what the name is on the credit card, it is always backed by a bank. So the again, you'll get a statement, and the statement will tell you what you've spent using that credit card, and you are going to match that against the receipts that you have, or the ledger that you've kept, or the software that you have used that says, I have spent this amount of money for these items and I paid for it using my credit card. Now, I have to pay the credit card off because credit card is not money. Credit card is a loan. So a lot of different concepts there, but there are things that you should be already familiar with because you've been doing this for years. The minute that you have money coming, you started this when you were 5 years old. Okay. And as strange as that may sound, you started this the moment that your grandmother sent you $5 for your birthday. And so what did you do with that $5? You did not go out and spend it. What the first thing you did was negotiate with your parents on how you could spend it. So, can I spend so much on candy? Did your parents say, well, wait a minute, some of this needs to go into church, some of this goes into savings, et cetera, et cetera. So it's that money coming in. I know $5 came in. What's going out? Not only what's going out, but where is it going to? Yep, I did get my candy, but I also had to put something in savings, and I also had to put something in church, and I also had to do whatever, okay, whatever my parents said to do. You do the same thing now. You get money coming in, you sit down and figure out how that money is going out. And you may not be negotiating with your parents, you may be negotiating with yourself to figure out what is it that I need to pay out of this money that came in. When is that bill due? When did I get my money in? How can I pay this all so that I am up to date on all my bills? So the concept is not a new concept. Some of the words may be different. And because we live in an electronics world right now. It used to be that you got a piece of paper in the mail from the bank and it said, this is your bank statement for the month of June. And you would sit there, you'd look at that and go, okay, they say that I paid this. I said They said this is the money that I spent on one side, and I say this is the money that I spent on the other side, and I want to match. My goal in reconciling my account is that the bank and I agree on what I have done with my money during that time period. Because things are electronic, you don't need to wait for a piece of paper. You can go in, and I recommend this highly. You go into your bank account at least once a day and check what's happening in your account. Identity theft is a big deal. It used to happen to other people. Now it happens to all of us. And unfortunately, it happens to a lot of us because we don't take that moment to check what's going on in our businesses from a financial standpoint. So I recommend that you check your bank account at least daily. You're not looking at every transaction that was ever done. You're looking at what happened yesterday, what happened the day before. In the bank that where I bank, they put in what's pending. So if I went out and I spent some money and I go back to my bank account, it tells me that money is still pending. It has not cleared through the bank completely yet. When you're using a credit card, same thing. If I went out and used my credit card for something, if I check my credit card account electronically, it tells me what's still pending. It has not cleared that credit card yet. Sometimes it may take up to 48 hours to do that. That's why I'm going in every day and I'm taking a look. What I don't want to have happen to you is that somebody else takes a little piece of your money just to test to see, are you doing this? And when they realize you don't ever look at your account, the next time you look at it, you may not have any money. We definitely don't want that to happen. So I want you to get in the habit of, the term is called reconciling, and it just means that the bank and I agree. So when we're looking at bookkeeping, think of things like, one of the things we talked about is get some software. And so that is something that you can research on your own. Any questions that you have, you're more than welcome to ask me. The one that you will probably hear about the most is QuickBooks. And there are a lot of people who use it, and there are a lot of people who like it. Okay, so just that is one of the softwares that's out there. Always make sure as a business owner that all of your business finances are in your business finance accounts. They are not mixed with your personal accounts. That's what the IRS calls commingling. And commingling, they will slap your hands. Well, they'll do more than slap your hands. But you want to always make sure that your business activity is coming from your business accounts. If you have a credit card, is it a business credit card? If you have a checking account, is it a business checking account? If you could have your business accounts at a bank differently than where you have your personal, it does not matter. Or you can have the same bank. The point is, you need to keep your business stuff separate from your personal stuff. That is probably something that every accounting professional, financial professional will kind of pound on you about, because it is so very, very important that you always keep things separate. So one of the things that we're also looking at, we talked about reconciling your account. We want to make sure that this account, the bank and I agree that we've said, yep, though you said I spent that, I've got something to prove I spent that, we're in agreement. We want to track sales, and not only do we want to track sales because we want to know what we sold, and we want to know who we sold it to, and we want to know how much we sold it for. But we also want to make sure that those sales are deposited in your account. I have had clients who tell me they have really good customers. And Jones and Brothers, they're one of our best customers and they're constantly buying stuff from us. But when I look through their books or when I look through their accounting system, I don't see the Jones and Brothers are paying them like they should. I see that they send out invoices. I don't see those invoices are paid. A customer is not a customer until the check clears. Okay. Until the money is in my bank, securely in my business account. Now that is a customer. As long as the customer still owes me money and I've sent out the invoice was due on the 10th, it is now the 22nd. I don't have my money. That's not a customer to me. They're trying to use me as a bank. I'm not a bank. I am a business that is selling goods or services. So make sure that when you're working with your customers, you want to make sure that they pay you in a timely manner because you need to pay your vendors in a timely manner. It's extremely important. That's how you run your business. Money coming in, money going out. Do you write checks for business expenses? And many times people still do. I have clients who write checks. They would write a check before they would use a credit card. That's okay. They will write a check before they use a debit card. That's okay. That's their choice. The point is, what are you doing? Well, how are you paying your business expenses? You don't have to write a check to pay your expenses in our electronic age. You may be paying them through a business debit card or through a business credit card, but you need to make sure that your expenses are taken care of. If by chance you are using a credit card, remember you want to put as much on that credit card that you can pay off at the end of that month because a credit card is not money, it is a loan. So anytime you're using your credit card to pay for something, remember that you have just borrowed some money from that credit card that you have to make that payment when that credit card statement comes in. You want to, the bank that I go to, what they do this, and I swear they do this for me, but they do this to help people keep separate the business and the personal. So if you have two credit cards, you have a business card and you have a credit card, they have two different colors. So that if you pick up the blue card, which is your business card, and you're at the grocery store, you know you picked up the wrong card. Put that one back. Pick up the green card, which is your personal card, and that's what you're going to pay for your groceries with. So you want to have something that makes you remember which one is the business card and which one is the personal card, because we can kind of get into the habit of just grabbing a card and pulling it out to use it without taking the time to check to see, is this the right one? You want to pay your business expenses first. Now, why do you want to pay your business expenses first? Because you want to get and maintain a good credit score for your business. You haven't gotten there yet because you're a new business, but as you accumulate and as you pay your bills, you will start to build a credit score that is going to be separate from your personal credit score. This one is going to be based on your business. You want to make sure that you pay your business expenses so you can continue to stay in business. You want to generate and use a profit and loss statement, and we're going to talk about what that is. And when you pay your business expenses, do not forget you. You need to pay you. You need to take money out of the business and pay you, the person, so that now you have personal account. Now you can go and buy the shoes for your children or go out to dinner with the family or whatever. That's from the personal money that you spend. So that's why you want to keep separate the business from the personal. And when it comes time, just like when you were W-2 employee, if you got paid on Friday, you knew there was a check. How are you going to pay yourself as a business owner? You're going to pay yourself every week? Then you need to take that money out of the business account and put it into the personal account to keep those two accounts separate. So business management software, okay? So this is something that can be confusing to some people, and for others, it's fine. What you have to figure out for yourself is what is it that you need? Because you may not need the most elaborate kind of software that's out there. You just may need some software that says, instead of me putting this on a piece of paper with one side saying money coming in and the other side saying money going out, I just need the software to tell me, okay, where's the money coming in part? Where's the money going out part? That's all I'm doing. So now I want to pay for the software that will give me what I need right now. You want to create reports from that software. So instead of sitting down and have to figure out how do you come up with a report, because you wouldn't know probably how to do that, then the software can do that for you. You want to track how your money is moving in your business because it tells you how healthy from a financial standpoint that your business is. That's extremely important to you because how do you make good business decisions about what's happening in your business if you do not understand your money? I had a client that was going to visit one of his customers, and he passed a lot. He was a contractor, and he passed a lot, and he saw that there was a backhoe for sale, and he needed a backhoe. So he went in and he talked to the people who were selling the backhoe. They were selling it. I can't remember what the amount was, but let's just say it was they were selling it for $100,000. Okay. And so he can't make a decision about whether he wants to buy this backhoe or not if he does not know how much money he has. He can't make a decision about how to use the backhoe because he can't buy the backhoe until he understands how much money he has. And that's the part that you need to constantly be on top of. You're going to run into what you think are some bargains out there in the world, but if you don't know how much money you have to spend on that bargain, it's not a bargain for you. So software is going to help you track your money. It's going to tell you because you're checking your bank account on a daily basis, you're going to know how much money you have. You're going to know when that bargain comes up, yes, I can do it, or no, I can't. So you don't use paper to run your business. You need, as you grow, software. It doesn't mean that you have to start out with the software. You can if you want to, but it does mean that as you grow your business, you want to have something that is going to help you grow your business and keep you on track of how your money is moving in your business. So there are three financial statements that your bookkeeper and your accountant are always going to be looking at. One is the balance sheet, one is the cash flow projection, and one is your profit and loss statement. Okay. So a balance sheet, a cash flow, and a profit and loss statement. You may have heard these terms before, but let's go into what they really do. So, a financial statement, when we're looking at a balance sheet, what does a balance sheet do? So, if you go to page 10 in your book, and if you look at page 10, 11, and 12, it's going to show you what a balance sheet looks like. Now, let's talk about what is actually in a balance sheet. Balance sheet has three things that it tracks at all times. It tracks your assets. That's the stuff that you own. Okay, so that says, oh, this is this is my business and these are the things that I own. I own my money in the bank. Okay, so if I've got $5,000 in my business checking account, that's an asset. We call that, in accounting terminology, we call that cash. Okay. And we call that cash because we can actually go to the bank and take it out and spend it like cash. It belongs to us. We buy equipment. We talked about that backhoe that the contractor had looked at. We buy equipment for our business. We own that equipment. That is an asset to our business. So assets are simply things we own. Liabilities are looked at as things we owe. So if I borrowed money from somebody, I owe them that money to pay it back. So that would be a liability. If I have employees in my company, I owe them their salaries. That's a liability in the company. Okay. So liability is not a bad thing. Liability is just stuff we own. We owe that to someone else. And then the third part of what a balance sheet does is called equity. And equity is simply what's the worth of our business. If I know how much I have in assets and how much I have in liabilities, then I know the worth of my business. For instance, if I have $100,000 in assets and I owe $75,000 in liabilities, the worth of my business is $25,000. The equation is very simple. It is assets plus liabilities equal, I'm sorry, assets equal liabilities plus equity. So on the asset side, and the reason it's right side and left side, because when I went to school, we did this on paper. We didn't have software. So we did this on paper. It was called a paper ledger. All the assets were put on the right-hand side, on the left-hand side. All the liabilities and equity were put on the right-hand side. And the total at the bottom must always balance. Assets must equal liabilities plus equity. So that's kind of an accounting kind of thing. But in your head, I want you to think about, what is it that the company owns? Do I have a building that I own? Do I have a vehicle for the company that I own? What is the cash that is in the bank account? Do I have inventory that I own? Okay, so those are things I own. What are the liabilities that I have? Okay, do I owe somebody something? Do I have to pay employee benefits if I have employees? Do I have to pay back loans that I have gotten so that I could buy those assets? So then I have to pay back those loans. Those are liabilities. And then the equity is going to be, okay, as I'm working my business, how healthy is my business? What is the equity that I have in the business? So how much is that business worth to me? So when you review the balance sheet, you're going to be in that balance sheet is on page 12. You're going to be looking at how much money does this company have? Money not meaning cash, because what assets do is what we're looking at, what can turn into cash, but it is not cash. My piece of equipment is not cash. My piece of equipment has a value to it, but it's not cash. Okay. So when I'm looking at my assets, they break them down between what's called current assets and fixed assets. A current asset simply means, what do I have that can be converted to cash easily within a 12-month period? And then my fixed assets are, what's going to take time for me to convert that into cash? If I have a building, I probably can't convert that into cash right away. If I have machinery, I probably can't convert that into cash right away. So, but if I have money in the bank, if I have accounts receivable, which means I've sent out invoices and people need to pay me, I can convert that into cash pretty fast. Okay. So from a liability standpoint, I'm looking at, what do I have to pay out? So I have current liabilities. What can I pay out that is going to be paid within the next 12 months? That's current. Now, what you don't have in liabilities is something called fixed liabilities. You don't, like you have fixed assets, you don't have fixed liabilities because you don't want debt that never goes away. What you have on your balance sheet is called long-term liabilities. If you own a home and you have a mortgage, your mortgage is called a long-term debt because you pay that off over several years. Sometimes you do that with a car. You don't pay your car off within the first year. Maybe you have a loan for a car that runs 5 years or even 7 years to get that car paid off. That becomes long-term debt. It's past 1 year. And then for owner's equity, what are we looking at from owner's equity? Well, we're looking at, when we get to our profit and loss statement, we're looking at what money have we made in the business that didn't go out to somebody else. So that's retained earnings. That's earnings that we have made in the business that we're keeping. That goes under equity. And what is it that the business is doing that keeps that money in there, that increases the value of the business? If you have a business that has stock, stock becomes part of that owner equity. If you have a business that doesn't have stock, then you don't have that on there. Okay. So I don't want this to be confusing to you. I want you to understand that there are pieces of this that when you're talking to your accountant, or you're talking to your bookkeeper, or even when you're talking to getting your taxes done, you need to have a general understanding of what these reports mean and what this terminology is, so that if you have a question, ask your question. Please feel free to ask as many questions as you need to, because it's important that you understand what these things mean, because they're directly affecting your business. So let's look at cash flow. Cash flow, I told you, you've been doing cash flow since you were 5 years old and you got money from your grandmother, right? Cash flow is money coming in, money going out. So you're always looking at the balance of cash received minus the amount of cash that's paid out. So most businesses will do their reconciliation, their formal business reconciliation on a monthly basis. If you're not doing it on a monthly basis, get into the habit of doing it at least monthly. Okay. You get the formal bank statement, even though you can check your you can check your bank account as many times during the day as you want to because it's electronic, but you get a formal statement from the bank that says from the first of the month to the end of the month, these are the transactions that we have captured going through our bank out from your business to whomever you're paying or whoever is paying you. And so that's when you do the formal reconciliation. It says the bank said this thing happened. We agree. We show everything that the bank says happened. We say happened. We agree, and therefore we have reconciled our accounts. That's important. Why is it from a cash flow in from a cash flow basis, why is that important? Because you need to know how much money you have, and you need to know how much money you can use, and you need to know how much money you may need. So you're always looking at what's the money coming in and what's the money going out, and you're looking at that on a consistent basis. You do it formally on a paper once a month. You do it informally on a constant basis. So a financial statement uses some basic assumptions. Okay, it says that the company has money come. When they say cash, they just mean you've got revenue, you've got money coming in and money going out. You are always looking at, I know what is coming in. I am projecting because I have sent out invoices that I want to have X amount of dollars coming in during this particular time period. So if I send out an invoice to a customer and on my invoices says due and payable upon receipt, I'm expecting that the minute that this customer gets this invoice, that the customer will pay me. Well, what if I send out an invoice that says due and payable in 15 days? Then I know that that money, I should be expecting that money within 15 days. I'm not expecting it right away. I'm expecting it within 15 days. What does that do to me as I'm trying to project how to use my money? It tells me when money is coming in so that I can project how I'm going to be paying money out. So you want to look at whether you've got cash flows, money coming in will be sufficient enough to cover your disbursements or your money going out. So I want to make sure I've got enough dollars coming into my business so that it covers the dollars going out of my business. That's basic cash flow. So how can a cash flow projection help? And when do you need one? Well, what are your goals for your sales? Are you expecting to do $10,000 this month in sales? Are you expecting to do $1,000 this month in sales? How do I determine my break even? So if you don't know what a break even is, you will know now because it's only 4 words. Break even is everything's paid, nothing's made. Now, you say, well, how can you do that? Well, we do that all the time in real life. We look at how much money we have in our paycheck. We look at the bills going out. We can cover all our bills, but we don't have anything left over. We don't have any fund money left over. That's called break even. I can cover all my bills with the money that I have coming in. We do the same thing in our business. If I can cover everything that needs to be paid by the money that's coming in, I have broken even. If I've got some money left over, I am not in a point of break even. I'm now in a point of profit. I have money that is beyond just what has to be paid to somebody else. So why do I need to know this? Well, I need to know when I can buy stuff. Hopefully, I'm not having any big emergencies pop up. But what happens if a tire blows on my truck and my tire costs me a lot of money because it's a special tire and it's a special truck, et cetera, et cetera? I need to plan for that. That could happen. If I am only breaking even, how do I pay to get that truck back into commission? Because that truck is important for me to do my work so I can send out invoices so people can pay me. I need to determine the cash that's needed to purchase inventory. So let's just say that you're a beauty salon and you buy shampoos and conditioners, et cetera, that you use as you do people's hair. So you can't have people come in to get their hair shampooed if you don't have any shampoo. So you've got to make sure that you've got enough cash that allows you to buy that inventory so that when people come in to get their hair shampooed, you actually have the shampoo available. So you are looking at tracking the liquidity when accrual accounts mask cash realities. Okay, so that's a very accounting kind of thing. What that basically means is, do you have the money to cover what you need to cover? That's all that means. Everything that we're doing, we're trying to make sure that we got enough money coming in to take care of the obligations that we have going out. Do you need to go ask for OPM? OPM is somebody else's money, right? Other people's money. Or do you need to go get a loan? Well, how do you know if you need that if you don't know how much is coming in and how much is going out? You said, I hope this is I'm kind of beating a horse on this, but I really want you to understand that the most important thing about your money is tracking what's coming in, what's going out, and how you then know when you need to ask someone else for help. So if you're going to go to a lender, and the lender could be a bank, it could be a credit union, it could be a family member, you need to be able to show the lender that you are a responsible person who is going to use the money that you get from that lender in a responsible way. So you're going to say, well, here's how I track my money. Here's how I show what money coming in. Here's how I show money going out. And so they can look at that and say, oh, okay, this is a responsible person because they've got a good tracking system. They actually know what's coming in. They stay on top of their invoices to make sure that people pay them on time. Once they get paid, they make sure that it is in their bank account. They reconcile their bank accounts. All of those things that we talked about. You want to be looking to the vendor like someone the vendor has confidence in. You need to present yourself to the vendor as the person who is responsible in using money. And when you get the vendor's money, you're going to have that same responsibility to that money also. So just like if you were a person who was going to lend money to me and you've never met me before, and I just walk up to you and I say, I'd like to have $10,000, you're going to ask me a whole lot of questions. So when you go to a lender, and don't get frustrated because they ask you questions, They're doing the same thing that you would do if you had the money to lend. They want to know that you are the person they can put confidence in, that not only you use the money responsibly, but you also pay them back according to the terms that are set up. So a cash flow projection is looking at how you're using money. And there are different ways that this is done. Usually your accountant does this looking at how do you pay your bills? How do you invest your money? Do you invest your money well? And what are you investing in? Those kinds of things, okay? What you're thinking about from a cash flow standpoint is tracking what's coming in, what's going out, and making sure that you're not short someplace. Because short is not good in business, okay? So when you're looking at cash flow, you want to be looking at how much you're selling. You want to look at if things aren't going the way that you want them to, and you're thinking, wow, I should be making more money. Do you need to sell more items? Now, if you sell more items, will you be making more, not making more money, will you be making more profit? Because if you're selling items, you have to buy those items in order to sell them. Do you have to make those items in order to sell them? Is that going to increase your liabilities in order to increase your assets? Okay. The stuff that I want to bring in, the cash that I want to bring in, I want to bring in more. Do I have to pay out more to bring in more? These are things you have to think about. Well, let's look at, and this was something that I was taught years ago. I have a professional service. Okay, so I am a trainer. One of the things that I do when I go out is I give people, we have an agreement, and it says this is what I'm going to do for you for this amount of money. Now, what happens if I've got customers that give me a hard time, or customers that don't pay me when they should, or customers that are hard to deal with? And you're going to run into them. If you have not run into them already, get prepared. One of the things that I can do, and I need to bring more money into the business. I'm not trying to lose customers and lose money. I'm trying to bring customers into the business who will keep my business growing. So if I want to get rid of a customer, this was what I was taught. Increase your price. So, oh no, if I increase my price, then I'm going to lose all these customers. Are you going to lose the aggravation that they bring you? Are you going to be able to build your business better with a price increase? Are you going to be able to stop just breaking even and now start building a profit? These are things that you have to think about in terms of what you're offering to your particular customers. Can you reduce expenses? If I'm looking at this and I'm saying, oh my gosh, I've got way more money going out than I have coming in, this is not good. You know this from running a household. This is not good. I can't, as my mother would say, I can't have more month than money. So what can I do? Are there things that I can do to reduce my expenses to compensate for the amount I have coming in? Do I need to change the timing on my expenses? Maybe they're coming in at a time where I don't have the money in yet. So maybe it's just something as simple as timing. Can I save money to have significant opening cash, get through the startup period? If you're just starting your business, guess what? You don't have any history. You don't have any, like, I'm looking at what happened last year so I can project what's going to happen this year. You don't have a last year. You just started this. How do you start a business? A business does not start on zero. There has to be some money somewhere. Are you the person who has saved up some money and you're starting your business with that? Are you the person who has family members who said, yes, we're going to contribute to your business because we want to help you grow? Are you the person who has already gone to a bank, showed them the idea of your business and how you plan to run your business, and they said, you know what? This sounds like a good idea. We will definitely lend you X amount of dollars. So, but understand when your business starts, you're starting from zero. You don't have any sales. You don't have any money coming in yet. So how do you get your business started? And you have to make sure that that's covered. I have a friend who is a realtor, and she said when she got her license, she was just so gung ho to go out and sell houses. And the first thing she was told was, before you go out and sell houses, make sure you've got at least 6 months worth of money put aside to take care of your bills, because customers don't buy when you are stressed out, when you're coming to the table and you're so nervous and I gotta get this sale, I gotta get this sale. They don't buy that. They don't buy that. You're supposed to be helping them get what they need. Excuse me. Get what they need, get what they want. You're not supposed to be bringing them stress. Stress they can get for free. They don't have to pay you for that. So what you want to make sure of is when you start your business, do you have money put aside so that you can pay your rent, so that you can get your groceries, et cetera, et cetera, that what you need in order to take care of yourself so that you're not going out and selling desperation. What you're selling is an excellent product or service that your company has. So you want to um, maybe what the bank said was, I'm not going to give you a loan, but I'll give you a line of credit. What's the difference? Okay. A loan is a set interest rate to it. And if I'm borrowing $10,000 from the bank, it is $10,000. And that $10,000 says I have to pay it back in a particular payment structure with a certain amount of interest. So I can get a line of credit. What's a line of credit? I call it a big credit card. Okay. It works the same way a credit card works, in that it says, I'm going to give you $10,000 as a line of credit. You don't have to start paying me back until you actually use it. If I got a loan, the minute I got a loan, that next month, that payment is due, whether I've used the money or not. With a line of credit, it can sit there until I need it. It's my cushion money, maybe. It's the money that I'm going to use when I see something that I need to purchase. I've got this line of credit that I may have some of the money that I can purchase with. I'll use a piece of this line of credit in order to take care of the total purchase of that item. So if I have a $10,000 line of credit and I pulled out $2,000 to pay for this thing that I needed to get, I now still have $8,000 that I can still use to make purchases. When I pay back my $2,000, it goes back up to 10, just like what happens with a credit card. Now, this is something that if you're looking at a line of credit, you want to discussion with your lender. You want to make sure you understand how the line of credit works, what they expect of you, what kind of interest is attached to that. Usually that's a variable type of interest, not a fixed type of interest. Okay. Do you need to reduce or change the timing of your own money that you give to yourself? You say, well, I pay myself at the first of the month. Well, do you have money at the first of the month to pay yourself? Have all your invoices come in for that month by the first of the month? So you're looking always at balancing what's coming in and what's going out. You are in control of how your money moves in and out of your business. You're in control of telling your clients when to pay you. You're not in control of telling your vendors when you're going to pay them, but you can negotiate with your vendors to make sure that they get paid and it's in conjunction with how you're getting money coming in. Buying inventory, can you get a reduction? Can you get a discount? Hey, are you planning the kinds of things that you're purchasing from them? Can you get a bargain price for that? Okay. Have you been with them for a while? You're a really good customer. Will they give you a discount? Will they tell you, hey, if you pay us within the first 10 days that we send you out the bill, we'll take off 2%. So you're always looking at how you can balance, again, what's coming in and what's going out. Can you get credit from your vendor? I need to buy something on the 15th. I normally buy stuff from them on the 20th, but I need this right now. Can you get credit from your vendor so that you can do that? Back to that negotiating with your vendor to make sure that the two of you know exactly what's going on and it's making sense to how your business is being run. This is your business. You have negotiating power. Okay. And so you need to establish a policy to get paid sooner by your customers. Tell your customers what you're doing. Tell your customers, maybe you want to give them a discount if they pay you early. Maybe you have something else that you want to do. Maybe you tell them what it's going to cost them if they don't pay you on time. So maybe you have a finance charge that you add to what they're doing because they didn't pay you when they said they were going to pay you. So again, this is constant negotiation between money coming in and money going out. So that third financial statement is called a profit and loss statement, or it is called a P&L. So let's go back to the balance sheet for a second. Your balance sheet is think of that as a camera. It's a snapshot of a particular moment in time of your business. So if I were to ask you for your balance sheet from last year, you would give me a snapshot of your balance sheet as of December 31st, 2025. Tells me what your assets are, it tells me what your liabilities are, and it tells me what your equity is. With a profit and loss statement, it's a little different. Profit and loss statement is not taking a snapshot of a particular point in time. It's kind of like a video camera. It tells me, if I say I would like to see your profit and loss statement from last year, it's going to give me a picture of from January 1st, 2025 through December 31st, 2025. So it's going to capture all of that. It's not capturing a point in time, it's capturing the movement of your business. So it's going to measure your revenue and expenses over that time period. Most companies will do their profit and loss statements and their balance sheets formally once a month. Okay. So that gives you a feel for what happened during the month, and it gives you that ability to start projecting what you're seeing that that you want to have happen coming up during the next period. Maybe it's the next month, maybe it's the next quarter, maybe it's the next year. You want to track profitability because we talked about break even. Break even is everything's paid, nothing's made. Once I get beyond break even and I've got money coming in, that's called profit. And profit is the thing that I'm in business for profit. I Profit is the salary that my business makes. My business works very hard and wants to be paid, and it wants to see its profitability. It wants to see its salary. What's coming in? I don't want to work hard for break even. I want to work hard for a profit. Because if I don't have a profit, how am I going to put money back into my business? How am I going to make sure that my business can go to the next step? If all I'm doing is just paying bills, I don't have that money that I can stick back into my business to move my business forward. So it's also called a profit and loss statement. It's called a P&L. It's called an income statement. And then there's this long thing that is called from accountants, and I can't remember what it is. I'm sorry. But it shows how successfully the buying and selling process is working. I buy stuff to sell to somebody. And when I do that, my profit and loss state shows me how much revenue I have coming in from people buying my stuff, how much is going out for the expenses that I have to pay, and how much is left over to show my profit. So it measures the ability of your business to grow, to repay debt, and to support you. You went into business because, and you have your own reason why, but you didn't go into business not to make money. Even if you said, well, I do this for humanitarian reasons, absolutely. But if you don't have some money to back that up, your humanitarian reasons aren't going to be taken care of. The profit and loss statement is the most important report from your accounting software program. And this is the one that people watch the most. What most people watch is how much is coming in for revenue and did I make a profit? There's a whole lot more to your profit and loss statement, so don't get hung up on just that. That's not enough. You need to know more. You need to know what's coming in. You need to know what's going out. You need to know why it's coming in and why it's going out. Okay. So if you go to page 17 in your manual, you will see there is a sample profit and loss statement. So everything has a formula, right? So we said the balance sheet formula is assets equal liabilities plus equity. Your profit and loss formula, my profit and loss formula is more simple than this. It is money coming in minus money going out tells me I either have a profit or a loss. So this breaks it down into, this is when you're selling goods, and not all of us sell goods. Some of us sell services. So it says, okay, we have sales coming in and you have the cost of putting together that thing that you're selling. So that's called cost of goods. So you minus that out. That gives you what is called a gross profit, which basically says, this is how much it costs me to get that sale out. If I'm selling something for a certain price and it costs me something to buy that thing to sell, then my gross profit says the difference between the sale and the thing that I bought to sell is my gross profit. But I can't live off my gross profit because I still have all these bills to pay. I still have to pay rent, I still have to pay utilities, have phone bill, et cetera, et cetera. That gives me what is called my net profit. And my net profit says I made money. This is called a profit and loss statement. What does the loss part mean? The loss part means I didn't have enough come in sales to cover my expenses, and therefore I have a negative for profit. I have a negative profit or I have a loss. This is the only financial statement where you can have a loss. You can't have a loss on a balance sheet. Balance sheet must balance. Assets must equal liabilities plus equity. You can't have a negative on a cash flow. You either had the money or you didn't. There's no such thing as negative cash. When I was going through accounting in college, they told us negative cash was fraud. So there's no such thing as negative cash. You either have the money or you don't have the money. In a profit and loss statement, how can you have a loss? Well, let's just say that you are selling a good, and a good example of that is Christmas is coming, and you are selling things that you know Christmas is going to be a really good time for you because people buy a lot of your stuff at Christmas. But you may start buying this stuff in June, July, August, September, October, building that inventory so that you can sell it at Christmas. So you have bought more during those months than what you actually have coming in from sales you've made. So you could have losses on your profit and loss statement, but in November, when people start buying your stuff, you could have a big profit because you're now selling all the stuff you purchased. And now you have more money coming in through sales than going out through expenses. So you can, on a profit and loss statement, you can say, oh my gosh, I had more in expenses than I had in sales. But you need to be projecting that. You need to understand if you are a cyclical business, if you have a cycle, like you have your biggest amount of sales at Christmas time, or you have your biggest amount of sales at Valentine's, or whatever it is, you need to build that into the structure of how your money moves in your business. So the basic formula for a profit and loss statement, from my standpoint, is very simple. Money coming in, sales, revenue, whatever you want to call it, minus money going out, which is going to be your expenses, tells you whether you have a profit or loss. Okay? So what does your profit pay for? Well, your profit pays, if you are a sole proprietor, your profit pays for your salary. That's that draw that you take out. You're drawing that money out of your business and putting it into your personal account to take care of your personal needs so that you don't have any personal expenses in your business account. Your profit pays for future expansion and equipment. It pays for your principal loan payments, pays for your income tax. What does your profit pay for? Remember that your profit is like the salary that your business makes. So what happens is, how do you use your salary? Use that salary to keep my business moving, to make sure that I've got enough to pay for those things that my company needs. So, how do you compile a profit and loss statement? Said, oh, it's easy. Well, if you have software, it is easy. You push a button that says profit and loss statement, and it magically appears just for you. If you have software and you push a button that says balance sheet, it magically appears for you. Now, how does it magically appear? It magically appears because you have already put that money in. You have already taken care of putting in all those transactions that we talked about at the very beginning. And those transactions will then group themselves according to how the software has it set up and how you have categorized things, how you have said, this is where I want my money to go. And therefore, you can see that you've got a profit. So, when you look at the profit and loss statement, you're going to do this the same thing that you did with your balance sheet. Just going to take a look at it. You don't have to go into depth or anything. I just want you to get a feel for what it looks like. And then as you're working in your business, you can now start asking questions about, where do I put stuff? Where should, I'm trying to track things for my business. How do I do that? So when you look at the profit and loss statement, do you think this business is well managed? Did it have a profit? Is there anything that stands out to you that you think might be a problem? Do you see growth potential? Are you getting the feeling that what you do with your money has a direct impact on how your business grows? That's the whole point. If I'm looking at my business and I've got a goal for my business and I've got a direction for my business, will my money support that? So, what is business financing? Oh, we talked about that before too. What is business financing? It's using somebody else's money, right? OPM, other people's money. But are there other ways than just going to a bank or a lender? There are. There's a thing called equity financing, okay? And equity financing is saying, let's just say you have invoices that people have not paid, and a company comes along. They're called factoring companies, and so a company comes along and says, I will buy those invoices from you for a certain amount of money. So they will give you pennies on the dollar for those invoices. But if you need that money right away, you may say yes to that. And then you sell those invoices to those people. Those customers are no longer your responsibility. They don't have to pay you those invoices. You've sold those invoices to a different company. It is up to that company to go after them. And that's where you get the whole idea of debt collection. Okay, because a lot of that's what these companies do. Some of them are attorneys, where they go out and do the same thing. Some of them are factoring companies. Some of them, that's the whole thing, that their whole business is wrapped around going and finding people who need money and buying those assets, because the invoices that you send out are considered assets, because that's money that you're expecting to get in. And you sell that to someone for whatever the negotiated price is between the two of you. Now you have money that you can do something with, and now the other company can go after those customers and say, now you owe us. You owe us. You don't owe your company anymore. You owe our company now. Okay. So what is it that you should be doing? You may want to invest your own money in your business. Now, why would you do that? Well, number one, that gives you the startup cash capital that you need, or it may give you that influx of capital that you need in order to grow your business. But that also helps you if you go looking for a lender and the lender sees that you think enough of your business that you will actually invest in it yourself. It makes the lender think that, oh, maybe this is worth me investing in also. Okay. So it gives you that right to borrow. You earn that right to borrow because what you're basically saying to someone is, hey, I got a lot of faith in my company. I'll put my own dollars in my company and I just don't have enough of them. So I need some of your dollars too. You want to look at profitability at all times. Is my business profitable? Do I have enough money coming in that allows me to pay all my bills? That's break even. And there is money left over that I can churn back into my business or I can give out to my shareholders. So that's what my profit is doing. Do I understand and keep working capital? Do I have enough money set aside when we talked about that whole cash flow thing, right? So do I have enough money set aside that when I see that backhoe, I know I've got it. I got it. I can get that backhoe. Or do I have enough money set aside so that if I go ask for a loan, I'm asking for a $20,000 loan. I got $10,000 of my own. Now, do you think that somebody would give me a $20,000 loan and show because I'm showing obviously I need $30,000. I didn't ask you for the whole 30. I'm putting in my 10. And the lender can look at that and say, oh, okay, here's somebody who's putting what they call skin in the game. Okay. They're putting in their money. We'll put in our money and we'll do this together. I want to look at my fixed assets, those things that I have that take a long time, that I've accumulated over a long time and I'm holding on to. I want to look at that to see is that balancing in my business? Does that make sense? Okay. I want to match the sources and uses of funds. I want to make sure that when I'm asking for money, I already know how that money is going to be used. I want to make sure that it makes sense in how I'm using that money. I need to understand my financial statements. So when I first started consulting, going out on the road, working with small business owners, I found that the most important thing for me to do with small business owners was to teach them how to read and understand their financial statements. They had almost all of them had very good financial professionals working with them, whether it was a big bookkeeper or a CPA or whatever. They had good people who were keeping good records. They just didn't know how to read them. They didn't know what the good records meant. So as a business owner, it is your responsibility to know what that means because that's one of those tools that you're using to build your business. You need to understand collateral. If I'm going to go out and ask for a loan, is somebody saying to me, well, I can give you a loan, but I need to have some collateral. Well, what is collateral? Collateral is something that I own that if I don't pay that loan off the way I should, the lender can take that money out of my collateral. Maybe I have a car or I have a truck or I have a building. And they're looking at those things like, what if I need to pull my cash out of those things? Is there enough cash there for me? What is the collateral that you're putting up so that I will say yes as a lender to lending you money. The deep conversation that you want to have with the lender so that you completely understand what is expected of you and that you completely understand um, what the lender wants and what you can offer. You need to look at the costs, the risks of loans, and there's all kinds of loans out there. Okay. Now, we put in no grants because they are very, very few and far between. Yes, there are business grants, but they are very few and far between, and they're probably harder to get than it is to get a loan. Spend some time looking at what's out there. Find out what is offered in your community. Here in our community, money pops up in different ways. It may come from the county, it may come from the city, it may come from the state, it may come from a credit union, it may come from a bank. We don't know where it is, but we need to be aware as much as possible of where money can possibly be. And that's why once we know where it is and we know how we want to use it, let's go after it. Let's go see if we're eligible for that funding that's coming from the county, or maybe there's a grant that's coming from the state. But remember that when we go after other people's money, they're going to ask us questions, and we need to be able to answer those questions fully. And then, of course, my favorite thing with you is have a trusted advisor. Always get good advice before you sign anything. If you have not read and do not understand what you're signing, please don't put your signature on it. Because your signature says, I got this. I know exactly what I'm doing. I know everything that's in here. I'm fine with this. If you are not, ask questions until you're comfortable to sign. They say, well, you can't get the loan if you don't sign the papers. Okay, but let me understand what the papers say, because I need to make sure that I can do what you want me to do. So if I'm signing something and then I look at it and go, I can't do that. Well, you already signed it. Now you're obligated. You don't want to put yourself in that position. So what do you need to do to go get a loan? You need to have a business plan. Okay. Everybody says that, oh, you're a business, you need to have a business plan. We need to talk about what that actually means and what a business plan needs to look like for you. You need to know what you can afford. Can you afford to pay this back? If my payments are going to be $1,000 a month, that's an additional $1,000 that I'm now paying out. Am I going to have enough coming in revenue in order to pay that additional $1,000 out? You need to know what is in your books. You need to know what your financial statements say, what they mean, how you can have a conversation with someone about your financial statements, because they're going to ask you questions. Check your credit report. Now, if you're a new business owner, you do not have business credit. So, what kind of credit report are they looking at? They're looking at your personal credit report. And you want to make sure that your personal credit report is strong enough to go to a lender. Well, how will you know if it's strong enough? Ask the lender what they're looking for. If they say, we're looking for people who are 680 and above on their credit report, and your credit is at 550, don't go. You already know the answer is no. So if you still need to build that credit, because you may someday need to come back and ask for money again. Then you start building now so that you can build up to that point, at least that point, to where the creditor says, yes, you're now eligible. Establish your collateral options, know what you have and what you don't have, what you will put up against the loan and what you won't put up against the loan. Will you put up your own savings against the loan? Will you put up the equity in your house against the loan? If you're uncomfortable with those, then you don't need to go after a loan that says it has collateral, that it wants your collateral. You need to go after a loan that has no collateral attached to it. That means that your credit report needs to be very strong. You need to have a convincing dialogue with the lender. You need to have the paperwork to back up everything that you say. Okay. Show your equity contribution. We showed that part of the balance sheet that says equity. How much is there? How much is your company worth from an equity standpoint? And research. This is a big deal. Look for stuff. Go look. There's so much data that's out there. You have to start putting it in context so that it becomes information. And you want to research those financing options to make sure that you're getting the best deal you can get at this point in time. So you want to have your business plan, you want to have your financial statements, you want to have your personal stuff because you don't have a business history yet, okay? And you want to have your personal and your business tax returns if you are to the point where you've had business tax returns. You want to source an amount of equity contribution. I'm putting, I have a $10,000 savings account. I'm putting that $10,000 up as equity contribution. Have a credit report and have read the credit report and know what's in the credit report. Because again, if the lender is going to share that money with you, the lender is going to ask a lot of questions. You should never be caught off guard by a question from a lender. You should already have asked and researched and gotten an answer for that ahead of time. Okay. And then what is the purchase agreement? What is the contract? What is the thing that I'm signing? What does it mean? And yes, I do need to read it. I don't need to click a little button that says, yes, I agree, because I don't know what I just agreed to. Read and understand, ask questions. So what are the criteria that you need for a loan? Okay, so we just talked about that. You need a good credit score. You need to have equity that you can put toward the loan. You need to have the ability to actually be able to pay it off. And you need to have loan to value ratio. What does that mean? A ratio says how much money let's just say, look at a ratio between what I own and what I owe. So if I own $100,000, that's my assets, and I owe $50,000, that's my liabilities. My ratio is 2 to 1. I've got twice as much in my assets than I have in my liabilities. What does that say to the lender? That says that, oh, there's wiggle room in there for me to get paid. But what if my assets are $100,000 and my liabilities are $90,000? That's only $10,000 and you're asking me for 30. I don't feel comfortable with that because you don't want collateral. You're not putting anything in. I don't feel that you have enough wiggle room in there to actually pay me what you owe me. So hopefully that helps you understand from a lender standpoint why they're asking all these questions and why you need to know the answers. So what are some of your options for startup? Equity. What are you putting in? Okay. I had a business with a partner. I had no money. I was an equal partner in the business. I put in what's called sweat equity. I did the training, I did the designing of the courses. He put in the money that paid for the office that we were in and the equipment, et cetera, et cetera. Okay. Do you have a business credit card? Is your family backing you up, or are they telling you, why don't you just go get a job? Okay, so what do you have that you're bringing to the table? Where are you going and looking for loans? Usually we think about banks, we think about credit unions, but as I said before, look to see what the city has, look to see what the state has, what the county has. There may be some options out there. Sometimes they're loans, most times they're grants because it's money that the federal government has sent down to the states to support the small businesses. So some quick points to remember: that financing is getting the money that you need to start, operate, or grow your business. You're going to choose when you need that financing. You may never need it, but if you do, you have an option. We want to start with how money is coming in and how money is going out. We want to start with that. You always want to have your thumb on that. You want some kind of bookkeeping service that makes sense to you and your business. You don't buy an accounting system that makes sense to everybody else and not you. This is your business. It needs to make sense to you also. Okay. And then those 3 financial statements that we talked about. It's extremely important that you understand what a balance sheet is, what a cash flow is, what a profit and loss is, and that you know how to read and understand them. Now, you're not going to know everything that your accountant knows, but you know enough to start having a conversation with your accountant and asking questions. Well, wait a minute. I saw this from last year and I see this from this. Why is this different? Okay. And the factors that affect your ability to get a loan: your credit score, your equity contribution, your repayment ability, your loan to value ratio. If I am a lender, I'm going to ask you as many questions as I can ask you to make me feel comfortable that you're going to pay me back. So that was long. That was a lot of stuff. Okay, I don't see anything. So hopefully this has been helpful to you, and that you have a better understanding of why this financial management is so important. That is one of the tools in your toolbox, and it is a very important tool in your toolbox because it is important that you understand where your money is and how your money works. Okay? So there is a form in your manual, and there's an evaluation form in your manual that I would love for you to fill it out and email it to me, please. It is a look at the training. Did it make sense to you? Are there things that could have been done differently? Were there things that we talked about that you already knew and that was redundant? Were there things that we didn't go into enough definition for you? Whatever you want to put on that evaluation form, put on that evaluation form. But I would have greatly appreciated if you would fill it out and email it to me, and you have my email address. So here's some references for resources that we use. One is called the Business Roadmap from the Department of Business and Industry here in Nevada. And it is simply that if somewhere in your journey in business, you may have a question, and maybe you have a question on places to go networking, then you just go here, click on the networking button, and it gives you sources where you can go network. Or if you're looking at, I'm going to get a business license, but do I need any other thing? Do I need any kind of permits or something? Here's a click on other licenses and permits and find out, do you need anything in additional? So this is a very good place to go just to figure out where you are and what the next step is. We also have, I've mentioned a couple of times that we have classes. We have a virtual video classroom, and this will be in the virtual video classroom, by the way. You can go here and look at the kinds of classes that we have. They are all at no cost to you. You're more than welcome to go, take a class. Some of the classes are in Spanish, some of the classes are in English. Feel free, okay? This is for you. This is the website that we have, so you can look at what the current classes are that we have coming up. You can look at the virtual classroom. You can look at who we are as a team who actually puts all this stuff together, different kinds of resource partners that we have. We have a podcast that we do. You can find us on Spotify. You can find us on a couple other things, other places too, and you can also find us on YouTube. And so this is our podcast, which is also done in English and in Spanish. So please feel free to listen to what we're doing. Now, who's on our podcast? Well, podcast is made up of people who are supporting the small business community. It could be a small business owner like you who's talking about, this is what I do, these are the kind of customers I'm going after, these are the kind of things that I do for my customers. It could be a politician who is talking to us about what is happening in the government that directly affects our small business community. It could be a resource partner who says, well, you know, we're ABC company and we're part of the state of Nevada, and this is what our division does for the small business community. So please feel free to take a look at our podcast. When we ask you to do that, please subscribe and follow us so that you know what we're doing and how this affects you. If you are not a client of the Small Business Development Center, I would highly recommend that you become one, because they have advisors. We talked about trusted advisors. They have advisors that can help you on your journey of your business growth. And you're going to go here to request advising, and it will come up with this page. You want to go to new client sign up and then put your information in, and this also is at no cost to you. And then the last thing I want to show you is SCORE. And SCORE used to be the senior core of retired executives, but it is more now people who have been in a particular position for a while, like maybe you've been marketing manager, or you've been HR specialist or whatever, and want to give back to the community. They want to help small businesses grow. They become your mentors and they walk you through whatever that particular area that you're interested in. So maybe you're getting new employees for the first time and you don't know about how to do an employee manual or what you need to, how to do an evaluation, et cetera, then you could go find a SCORE mentor who was an HR person and says, yeah, I'll walk you through that. I'll tell you exactly what you need to do and how you do this so that both you and your clients and your employees are comfortable. So this is it for us. Thank you so much. I know this was a long one today, but I hope it was a very, very helpful one. Okay? So go to your participant manual, and your evaluation should be in the back of your participant manual. Please fill that out and email it to me. I greatly appreciate that. Thank you for joining us. I hope you got a lot out of this class. If you have any questions, you know how to reach me. Thank you. Bye now.